Welcome to CoreLogic's housing market update for August 2024. Nationally, home values rose another 0.5% in July, on par with the 0.5% increase recorded in June and the 18th consecutive monthly increase in home values nationally. However, while the headline growth rate remains positive, it's clear momentum is leaving the cycle as conditions become more diverse. 3 capital cities have recorded a decline in values over the past 3 months, led by Melbourne with a 0.9% fall, alongside small reductions in Hobart and Darwin values. The rolling quarterly pace of growth has slowed markedly in Sydney to 1.1%. That's a fraction of the 5% quarterly gain recorded at the same time last year. These dynamics are weighing on growth in national home values, which are up 1.7% in the past 3 months, compared to the 3.2% increase we saw at the same time last year. The mid-sized capitals are continuing to buck the slowing trend, with the quarterly pace of growth in Perth tracking at 6.2%, while growth in Adelaide accelerated to 5%. That's the fastest rolling quarterly pace of growth since May 2022. Brisbane housing values rose at the quarterly pace of 3.8%, although this is down from a 4.7% increase seen at the same time last year. Available supply is a key factor explaining the diverse outcome in housing growth trends, with the number of homes for sale in Brisbane, Adelaide and Perth more than 30% below average for this time of the year, while weaker markets like Melbourne and Hobart are recording advertised supply levels that are well above average. A reduction in borrowing capacity and affordability factors are skewing demand towards the lower price points of the market, with lower quartile values leading the growth trend across every capital city except Darwin and Canberra, which are also the 2 most affordable capitals after adjusting for local incomes. At a combined capital city level, cheaper dwelling values are up 3.3% over the past 3 months, compared with a 0.8% increase for those at the top end of the market. Growth in regional housing values is once again lagging the capitals, with a rolling quarterly rise of 1.3% across the regionals index, compared with a 1.8% gain across the capitals. Mimicking the growth pattern seen across the capital cities, regional Western Australia, regional South Australia and regional Queensland led the rolling quarterly change. Regional Victoria was the only rest of state market to record a decline in values over the 3 months ending July, with values down 1.4%. Another broad theme in the housing data is that unit values are rising faster than houses across most of the capital cities. The only exceptions over the past 3 months were Darwin and the ACT, where affordability barriers are less pressing, and also there's a history of higher supply levels across the medium to high density sectors that's been more apparent. Most cities now have a median house value that's at least 1.5 times higher than the median unit value. With stretched housing affordability, lower borrowing capacity and a lift in both investor and first home buyer activity, it's not surprising to see the unit sector outperforming for a change. Changing the focus to rental conditions, CoreLogic's rental index was up only 0.1% in July. That's the smallest monthly rise since August of 2020. A clear slowdown in the pace of rental growth across the unit sector has been the main drag on rental growth, especially in Sydney, where the annual change in unit rents has dropped from 17.9% in May last year to 6.6%. Melbourne and Brisbane unit rents have also lost more than 8 percentage points in the annual growth rate. Slower rental growth is probably a factor of both slowing net overseas migration, but also influenced by rental affordability constraints. It's worth noting that the slowdown in unit sector rental growth is off a high base. Despite the slowdown, the annual pace of rental growth is still well above average levels in most regions. The underlying mismatch between housing supply and demand looks set to support housing prices through the second half of the year. However, there does seem to be some rebalancing underway. For some context on the balance between available supply and demonstrated demand, in the 3 months to July, CoreLogic estimates there were 125,000 dwellings sold across Australia, which is a little higher than the 121,000 new listings added to the market in the same period. This suggests there were still more buyers than sellers in the market, but the gap between sales and listings has narrowed since the same period last year, when there are 123,000 sales against just 112,000 new listings. Vendors have become more active, with real estate listings flowing into the market at a pace that's slightly above average through autumn and winter. The increased flow of advertised supply is testing the depth of buyer demand. At a macro level, demand is keeping pace, But pockets of weakness are emerging, with listings now well above average in Hobart and in Melbourne and normalising across Sydney. Beyond the number of homes available to purchase, the supply of newly built homes remains insufficient relative to population growth. A further 6.5% drop in dwelling approvals through June highlights the challenges faced by the residential construction sector. Profit margins have been compressed, skilled trades are scarce, and holding costs remain high. On the positive side, we're now seeing residential construction costs rising at the slowest annual pace in 22 years. Although the cost to build isn't reducing, the slower pace of growth should provide builders with some confidence that project costs won't blow out. Additionally, with established housing values rising almost 3.5 times faster than construction costs, profit margins should gradually start to repair. Investors are taking a larger share of demand. A key trend emerging from ABS lending indicators data is the upswing in lending for investment purposes. Nationally, the number of investor loans is up 24.8% on last year, and the value of lending to investors has jumped by 29.5% over the year to comprise 37.1% of mortgage demand. In WA, where home values have jumped 23.9% over the year, investor lending is up 53%, more than double the national average. The outlook for the housing sector remains complicated. While constraints on new housing supply are likely to keep a floor under home prices and remain a feature of the market for some time yet, clearly downside risks are growing. Housing affordability is becoming more challenging in markets where values are rising faster than incomes. In March, the national dwelling value to income ratio rose to 7.7 and is likely to be approaching new record highs once the June quarter data is published next month. Similarly, the portion of household income required to service a new mortgage was already at a record high in March and has likely risen further by now. With housing trends becoming more diverse and an RBA board meeting later this month, there'll be plenty of research updates from the CoreLogic team. Stay tuned to the news and research pages of the CoreLogic website.